This is your Mortgage Rate Watch for Wednesday, February the 9th, and I'm Keith Akada with the Mortgage Reel. We're keeping a close eye right now on the bond chart. Looking from right to left, you'll notice that we definitely have now the 8th consecutive day of negative territories for the bond market. So we're trying to form a floor of support. And what that means for current and future homeowners out there is that a floor of support would mean from rates going any higher. And that's what we're looking for right now, is any floor of support. But we really haven't formed a solid one. The key thing is right now, Wall Street is even taking the tune that the bond market is extremely oversold, and what a lot of investors are calling for a ripe to bounce higher. When we bounce higher, you'll see the green marks come back, and when that actually happens, that means that rates are actually improving in that moment. An action-packed day nonetheless, with the Fed speaking, and also at 10 o'clock Pacific time, we have the $24 billion in treasuries offered in 10-year bonds. And what we're really looking for there is any support coming in. If you notice from yesterday, a 3-year note went horribly bad. And what we're really looking for is investors to start seeking this long-term investment. Key thing here is if the investors do not have an appetite for the U.S. long-term investment, then that definitely shows that these monies are going into foreign investments because of interest rates hike, like what happened in China and Brazil yesterday. Those monies are going into the greatest rate of return. And if that return is not offered by the United States, that's definitely going to hurt our bond market. The Federal Reserve and Mr. Bernanke are getting serious questions coming from the House Budget Committee this morning, and it's actually being televised, and the stock market is also trading closely to this. What they're really looking for, again, here is any indications and verbiage on how the Federal Reserve feels that QE2 is either going to be pulled back or continue to be rolled out and move forward. And again, this $600 billion, though through 2010 it seemed like that was not even a drop in the bucket for the United States because we were spending over trillions. This $600 billion is very closely watched because it's one of the last things the United States at this time, what the Federal Reserve can do to, in their eyes, boost the stock market, reduce unemployment, and create inflation. And with inflation, again, that's the arch enemy of bonds. So if too much verbiage comes out about the fear of inflation, which seems to be right now in the media overblown, which is causing this, again, the bond market to be oversold, if that trend continues, we could see a move higher in interest rates over the short term. But it seems like right now we're ready for the roles to reverse and for the markets to come back a little bit, and that inflation has just been a little bit overblown due to what other countries are doing, not so much what's going on here in the United States. So let's hope that that is the fact today. Make sure to check the homepage of Homeowners Education 101 on the increases of the credit risk pricing that was just implemented by Fannie Mae and Freddie Mac, and how that impacts any current or future homeowner that's thinking about either refinancing or purchasing in the very near future. Leave any comments or feedback below, as it's not only appreciated by Team Mortgage Reel, but also by current and future viewers. Join the conversation on Facebook at How to Beat the Banks and like us when you're there. Otherwise, we'll be back tomorrow with more updates on your Mortgage Rate Watch.